Portfolio Builder members, today we have a new trade alert. And the topic of today's trade alert is that retail investors are flooding stocks after missing out on the rally. And our warning is to play it safe for the next 30 days and to look out below. So Friday we issued a covered call trade on the SPY ETF that was trading about $5 below the SPY ETF. And today, the SPY ETF has jumped much higher. So we're going to cover that position for a break even and follow the same strategy in today. We'll get into that in a minute. For now, let's look at what's going on in the markets, look at the charts, and then we'll finish up with the trade alert and go over how you make money, how you lose money, and what our plan is for the next 30 days to play it safe, because there are a few problems up ahead. In a majority of episodes, surging inflows were a contrarian indicator. 6 out of the 9 episodes saw the S&P 500 fall an average of negative 5.9% over the course of the following 1 month, accompanied by outflows. And so we can see as retail investors missed out on the spectacular gains of 2019, selling as it rallied higher. They're now late to the game, potentially. That is a big maybe, as they are now buying at record pace. So the fear of missing out, FOMO is what they call that. Exceptions were when inflows were just catching up after lagging the market in early and mid-2013 and in late 2016. Following the U.S. election, strong equity inflows continued for an extended period of time after the initial surge, driving the market even higher. These exceptions are instructive in that they all occurred when inflows were playing catch-up after lagging far behind a market rally, which may be the case now. And so we can see the S&P 500 versus the flows, and as the S&P 500 rallied, the flows into equity markets dropped this year. And that's because they got very scared in December when we had the Christmas massacre. Now, the main reason we're playing it safe for the next 30 days is because the biggest buyer of stocks is the corporate buybacks. And because they have earnings coming up from now until the middle of April, is going to become a blackout period where most corporations can no longer support their stock. So at this point, we're now relying on capital from potentially central banks, from retail, and from hedge funds. And so while I don't think we're going to see a stock market crash in March or April, I think the potential to go flat or down is more likely than it is to break into new highs where we've been stuck at the current resistance level. So I think we will be able to generate a very nice income playing it very safe over the next 30 days. The topic of reversing equity flows was also the key focus in the latest note from DB's Parag Thought, who writes that following large outflows of over $100 billion since October, U.S. equity funds this week saw inflows surge with $31 billion in the first 3 days, helping drive the S&P 500 back to the top of its recent range. However, arguing for the former, less cheerful take on the fund flow timing reversal is an additional downside risk that has emerged this week. According to Deutsche Bank, the number of S&P 500 companies in blackouts will ramp up sharply starting in the last week of March and peak mid-April, implying a reduced pace of buybacks. And so you can see it begins to ramp up into the next few weeks until it peaks and then comes back down. So the next 30 days I find highly unlikely will go higher than we are trading at today. The risk from vol control is to the downside. Volatility control funds were quiet this week. VIX dropped from 16 to 1350 over the week as the market rebounded. And so that's last week. Even lower this morning. Volatility control funds are near full equity allocations, so risk is to the downside if volatility spikes. Here's a shot today of volatility index, the VIX. And excuse me, it actually spiked today with the market jumping up so rapidly. So the VIX is a measure of acceleration on the S&P 500. So if it's moving in either direction at an increased rate of speed, the VIX goes up. And we do intend to use the VIX to help hedge and profit from downside risks this month, but we're waiting for weakness in the S&P 500. CTAs are poised to buy in the next 7 to 10 days if a sell-off does not materialize. CTAs are in an aggregate net long S&P 500 position and other equity indexes, however with lighter positioning than 2017 and 2018. The S&P 500's 50-day moving average rising and only negative 1.7% below the 200-day moving average. Expect more buying if these technical triggers cross. And that is likely to happen within the next 7 to 10 trading days if a sell-off doesn't materialize. And a quick summary of the money flows. The biggest U.S. equity inflows in a year with $25.5 billion. Japan had the 5th week of outflows with $1.1 billion. Europe actually is outperforming this year. And now we've seen a chunky outflows of $4.6 billion, probably some profit taking. Emerging markets, biggest outflows, $2.8 billion. But that's after record-breaking inflows to start out the year. And one last observation, the E-mini S&P FTSE liquidity remains abysmal with the average contract size just above 1,000 and roughly where it was for much of the 4th quarter in 2018, which we all know was very negative for stocks. This means that any abrupt and sustained reversal will likely lead to a sharp and violent drop in the market as multiple bid levels are taking out in a rerun of what happened in December. So again, the way we're playing this, if the market goes flat or down, we can do very well. If it goes up, we break even. And if it crashes at a greater rate than we've predicted, that's where we can lose. But we're going to lose a lot less than everyone else, and we may actually profit if we get our hedge in at the right time. Now I'd like to review the key events this week that I'm paying attention to. Monday, a quiet start to the week with the only data due being the March Rightmove House Price Index reading in the UK, January industrial production in Japan, the January trade balance for the Euro area, and the March housing market index. And we're at a point in time where weak data in terms of these prints would potentially remain bullish for equities because it'll keep the central banks in their dovish positioning. Tuesday, all about Brexit, but we'll also get the Bank of Japan's minutes from the January meeting. Most likely they'll continue being very dovish. And Wednesday's the big event. All eyes will be on the Fed meeting in the evening, which we expect no change, continued support from the central bank while the trade deal is negotiated. Now, if there is a surprise and they start talking about being potentially hawkish and raising rates, that would be a big shock to the market and another potential reason our play it safe strategy will do well. Thursday, we need to see the retail sales hopefully pick up. The January print was very abysmal. And then meanwhile, we'll be looking for signs of inflation from the PMI and the job market, which is heating up. And then Friday, we'll get similar data out of Japan and Europe. Meanwhile, the deal with North Korea seems to be tied into the China deal. And this has had a rumor spread that he may stop denuclearization talks altogether. So that's a bad sign for the trade deal. And then this morning, a note came out that the two leaders will not meet until June, which only leads one to assume that they are having trouble coming to an agreement And perhaps China is just going to keep kicking the can down the road indefinitely. In which case, what will Trump do? Will he raise the tariffs? So this is a little outline. If you want to pause it, read it. I won't read it all out loud, but this thing keeps getting pushed down the line, down the line, down the line, and they're making absolutely no progress. Meanwhile, if we look behind the scenes, China is injecting tons of liquidity into its banks, which is then providing support to their economy during this potential trade war. So perhaps they will make some progress, but right now this has now been delayed another potentially 3 months. Meanwhile, the relationship between the 10-year yield and the S&P 500 has broken apart. A lot of bond people are very bearish because of this. But it's just as likely that the 10-year yield may rise up to the S&P as the S&P drops down to the 10-year. We do know that the central banks are in a very accommodating mood right now and are supporting their bond markets and equity markets. And you can see that the inverse correlation between real yields and the S&P 500 is the strongest since 2010. Okay, now I'd like to switch to some charts, and then finally we'll go over the trade alert. So if we zoom into the daily view, we can see that we have just broke above this resistance level, and I think we're going to have trouble staying far above that. Without a trade deal, without corporate buybacks, I really see the S&P 500 having a very hard time getting above this level. And even if it were to do so, I would be highly skeptical that it could maintain such a high valuation with the looming risk of a trade war escalating. And over at the VIX, this is highly unusual when the VIX spikes on an up day, and that's because the market's going up at such a rapid rate that it has spiked the VIX's price. Now, this is a great tool for hedging our S&P 500 portfolio, our SPY position, but I'd like to see it potentially drop back down and then see some weakness in equities before we put on a VIX position. And we do that using a in-the-money call option. And then meanwhile, the other way we will hedge our portfolio is going to be using the QQQ, which is a more volatile version of the SPY. And so most likely we'll have around a 10% in-the-money VIX position to benefit from volatility. And then we will have an out-of-the-money put option on the QQQ representing around 1% of our portfolio to catch a big drop. And then on top of that, we're also protecting our capital by writing our covered call below the trading price. And this is how we can profit if the market goes flat or slightly down, and provide around $5 of protection every 48 hours. So you can see that we are covering our position for 733, which is the difference. The loss we're taking on the covered call is exactly the same as the gain we're taking on our underlying assets. So we do not lose money if the market goes up right now. We just don't profit. And if the S&P 500 SPY index were to drop more than $5 by Wednesday, this current trade alert could realize a loss. However, a lot less of a loss than you're going to see on all of the rest of your stock portfolio. So today's trade is to buy to close. For my portfolio, in the model portfolio, we have 1,700 shares of the SPY ETF. So we need to buy to close all 17 contracts we wrote last Friday. Then, right after placing that trade, we are going to roll over the position by selling to open 17 March 20th, 2019, 277.50 call options for a credit of $4.98 per share. So this gives us some downside protection, the opportunity to profit, and allows us to generate retirement income and play it safe right now. Now, for those of you just getting started in the trade alert email, if you click right here in step 1, It'll teach you how to get to your spreadsheet, how to fill it out, and how to figure out how many shares of the SPY ETF you need for your portfolio. It trades at $281 a share, so it's around $28,000 to start following this program. If we go down to the Poor Man product, we call this the Poor Man's Income Strategy. It's actually outperforming our SPY trade. You can follow this one for $36.50. This is where we're playing the 20-year Treasury rate with a double inverse ETF that has a huge yield. And so the trade alert for this is to buy lots of 100 TBT shares. And again, if you click here, we'll teach you how to calculate it with our Portfolio Builder platform. But the covered call to put on this position, if you missed our alert on Friday, is to sell to open 1 per 100 shares of the March 22, 2019 $35 call for a credit of 20 cents. Now again, if you did Friday's trade, we're going to just sit on it until next Friday and then roll over the position. But if you're just getting started, you only have $4,000 to put to work. This program is doing extremely well. And since we've launched it, it's up 8% and just keeps cranking in consistent returns. Now, to get this out quickly, I'm not going to show you myself placing this trade in here, but just to summarize, this is our Rich Man Income Strategy returns, and this is our Poor Man returns. You can see the real-time returns actually 2% higher than the price we put on our email update today. So we're doing even better in that portfolio. This is where we put our stock trades. This is where we have our open covered calls. This is designed to be super easy, one position at a time. As we close them, we plop them down here. And if we start to hedge our portfolio, those positions will go here. So I have a few tiny hedges open. When I decide to issue a new hedge alert, I'm going to close all these out and just simplify it to have one 10% VIX position that's long and in the money on a call option, and then a 1% total portfolio position with an out of the money QQQ put. So we're looking for some weakness before we jump into that bag. In the meanwhile, we're protecting ourselves with the covered call. Okay, thanks for your time. We have a live webinar for Q&A. I can even switch it over to your screen and help you fill out your spreadsheet. We can chat about the strategy, and if you have any other questions, I'll be there for 1 hour from noon to 1 Eastern today. Thanks again.